So good to have you join us today. Hello and welcome to Business Daily. I'm Lee-Ji-yoon in Seoul. Before we get started, let's first get a glimpse of today's highlights. Korea's shipbuilding industry continues to bleed from a slump in demand and failed global expansion. It's no surprise that smaller players are going out of business. China has been depreciating the yuan to try helping its struggling exporters. But there are fears that a weaker yuan could drive the global economy closer to a recession. We'll sit down with an expert to talk about this. But first, the Bank of Korea will release its new growth outlook for this year on Thursday, as it announces this month's key interest rate during its first monetary policy meeting of 2016. Now, all eyes are focused on to what extent the central bank will lower, as widely expected, its previous forecast. Our Hwang Jae starts us off.
3.2%. That's the forecast the Bank of Korea currently holds for the country's economy this year. It's in stark contrast with figures released by other major financial institutions that expect Korea's GDP to expand in the 2% range. And with the central bank set to announce a new growth outlook on Thursday, a downgrade in the current projection is widely expected.
Uncertainties stemming from the U.S. Federal Reserve's rate hike and instability in China's financial market, coupled with factors at home like the sluggish consumer sentiment, will dim the outlook for this year.
The focus is now on how much the central bank will cut from its existing forecast. Analysts say slashing it to the 2% range won't be an easy decision to make for the BOK, as it could further heighten uncertainties about slumping economic conditions among households and in the corporate sector. But with a trim looking almost certain this time, expectations are also on the rise for another rate cut down the road. That especially as countries like China and Japan, Korea's major export rivals, try to drag down their currency values, and Korea holds on to its strong economic fundamentals.
Except for the U.S. dollar, the Korean won is maintaining its stability against other currencies. Global ratings agency Moody's also viewed Korea's financial market as being relatively sound, and that means a rate cut won't lead to a major capital outflow.
And analysts say it could come as early as in the first quarter of this year if the economy fails to show signs of a strong recovery momentum. Hwang Jae, Business Daily.
Last year, Korea failed to reach its trade goal of $1 trillion after a 4-year streak. And the possibility of achieving it this year appears glum due to slow growth all around the world. But there's at least one research institute that says it's not entirely out of reach. Our Eunice Kim tells us why.
Let's review. In 2015, exports shrank by 7.9% and imports by 16.9% on year, adding up to combined trade worth $964 billion, still short of Korea's $1 trillion trade goal. And due to a slowed global economy at large, the government forecasts some growth in trade, though not enough to put it over the $1 trillion upper line. But Hyundai Research Institute put out an optimistic view this week, saying this could be the year Asia's fourth largest economy crosses that milestone. It pointed to 5 areas of opportunity that could boost exports this year. A world economy on the up and up, improved economic growth in the U.S., China's pivot to a consumption-driven economy, the fruits of a ratified Korea-China Free Trade Agreement, and the advancement of trade relations with emerging markets, including India and Vietnam. Vietnam last year leapt up to become Korea's 3rd largest export destination.
As China shifts its economic model, there's room for growth in Korea's consumer good exports. And since this year will be the first year the bilateral FTA takes effect, we're expecting a growth in outbound shipments to China.
Meanwhile, the Research Institute forecasts U.S. economic recovery will be more pronounced this year, expanding by 2.8%, which it estimates will raise Korea's export growth by 40 basis points. And as Korea's trade promotion agency KOTRA draws out plans to expand its presence in this South American market, eyes will remain transfixed on China, the biggest variable on the global stage, and whether the Middle Kingdom will be able to provide the confidence it and the world needs. Eunice Kim, Business Daily.
Global oil prices have sunk to a 12-year low on the back of growing concerns over China's slowing growth and a supply glut. The U.S. benchmark West Texas Intermediate fell below $32 a barrel, the lowest in 12 years. Brent crude also slipped to $31.48 a barrel, the lowest since April 2004. Now, analysts say the price drop is mainly driven by worries over the grim economic outlook for China, the world's second largest consumer of oil. And this decline looks far from being over, as Morgan Stanley and Goldman Sachs predict oil prices could fall further to a range of $20 to $25 a barrel. The world's shipbuilding industry, which was once dominated by Korean companies, has undergone some major changes in recent years. And our Young takes us to the city of Tongyeong to show us how much the country's shipbuilders have been struggling amid continued drop in new orders.
This is the city of Tongyeong, located on the southern tip of the Korean peninsula. The city is most well known for its shipbuilding facilities, but it's no longer common to see mammoth cranes up and running after the city's biggest and the country's oldest shipbuilder, Sina SB, pulled the plug on operations in November.
After going through a year and a half of court receivership, we were not successful in finding a new owner. So we had no choice but to announce bankruptcy.
Sina SB once boasted of having up to 4,500 employees, part of a company known for being one of the top 10 shipbuilders in the world. But now, only 23 are left, camped outside the company to express their desperation and hopes that the business will be revived.
People tell me that it's already over and ask me why I fight so hard. But I don't think it's over until it's over.
Sina SB represents one of Korea's smaller-sized shipbuilders that have been pushed out amid rapid growth by Chinese and Japanese competitors. The country's three biggest shipyards, Hyundai Heavy Industries, Samsung Heavy Industries, and Daewoo Shipbuilding and Marine Engineering, have also been stung after reaching an estimated record-high operating loss of over $6.6 billion last year due to a series of order cancellations and a delay in the construction of offshore facilities. Korea is still home to the world's top 4 shipbuilders, but in 2015, a Chinese competitor snatched up 5th place for the first time. Experts say this downtrend looks set to continue this year, as a combination of both internal and external factors have left the country vulnerable to further inroads made by foreign competitors. Lee Ju-young, Business Daily.
The real news is in China these days. Along with its latest stock market turmoil, it allowed the biggest fall in the yuan in 5 months last week, pressuring regional currencies and shaking up global stock markets as fears grew over the start of the competitive devaluations. And there are growing concerns that Korea might take a beating from the sliding Chinese currency. Take a look.
The Chinese yuan reached its lowest level against the US dollar in 5 years last week, following repeated depreciations by the People's Bank of China. As of last Thursday, the guidance rate for the yuan had dropped by 1.4% over an 8-day stretch, putting the currency value at nearly 5% lower than last year. But these moves have unleashed turmoil in both local and global stock markets, stoking concerns that the world's second-largest economy may be weakening too quickly. A latest report by Reuters suggests that the PBOC may let the yuan slide by as much as 15% to help protect the country's debt-laden companies. Amid all this, Korea's won also dropped by double the rate of the yuan last week, as the won's value has been closely in sync with the fall or rise of the Chinese currency and bourses. So how is the Chinese currency poised to perform in the future, And how can Korea gear up for these changes?
And to tell us more about this, Professor Yang Jun-seok from the Catholic University of Korea joins us in the studio today. So good to see you, Professor.
Happy to be here.
So tell us about the trend of China's yuan depreciation and how it has been struggling with a growing divide between on and offset trading of its currency.
Okay, well, even with all this depreciation, the yuan, at least in terms of nominal numbers, is back at the levels about 2010, 2011, so about 5 years ago. But if you look at, say, the period from 2008, the Chinese yuan hasn't depreciated as much as other major currencies like the yen or the euro or even the Korean won. So there probably is some more room for devaluation if you look at it from the global financial crisis outwards. Now, in August, they had a major devaluation then, and then they said that they will no longer just look at the US dollar yuan rates, but they would compare the yuan rates to a basket of currencies. That's been widely taken as a signal that China is willing to devalue its currency even more. So I think that kind of expectation is feeding into the markets, lowering the yuan value. And then because the yuan value is lowered, the investment profits from the foreign investment into China is also falling in terms of dollars, so a lot of people are taking that investment out, which is further feeding into the devaluation cycle. Now, so there has been some more pressure between the onshore and the offshore markets. Onshore markets within China, well, the Chinese central bank has good control over how the exchange rate goes, but offshore, they don't really have that much control. So I think the most of the global investors are feeling that the devaluation will continue. So at least in the offshore market, the devaluation is going faster than the Chinese central bank and the government would like. So I think that's creating some conflicts there.
But then just yesterday on Monday, a senior Chinese economic official said that it's ridiculous they were expecting further substantial depreciation of the yuan, and that China does have substantial or enough tools to, I guess, protect its currency from attacks. What's your thought on this?
Okay, well, the lower value of the yuan obviously helps exports, but if you look at some of the other countries which have tried the devaluation approach, there's question over how effective this is right now because the size of the global trade seems to be not growing as fast as it did in the past. On the other hand, because of the devaluation, some of the companies in China which have borrowed in dollars, their value of debt in terms of the yuan may go up, and that might create some real problems for some of these debt-ridden companies. So I think the Chinese government wants to walk a very balanced approach. They don't want things to change very quickly. They may not have a choice, but since they do have the world's largest dollar reserves, they do have the tools to slow down the change if they want to.
All right, but then we actually heard that some analysts and a report by Reuters saying that China's yuan could actually depreciate further by as much as 15%. Do you agree with that?
Well, I think it's within the realm of possibility. If you look at, say, only the last few years, 2 or 3 years, then yes, Chinese yuan have depreciated a lot in terms of comparison with other major currencies, except possibly the Japanese yen. But if you go back to, say, 2008, there were a lot of depreciation which took place within 2008, 2009, which China did not do. So if you look at it from 2008 point of view, then there is a room for further devaluation, but I'm not sure if China would want to go that far.
And there are also growing concerns among investors that this weakening of the yuan could reignite a currency war in the region.
Okay, that worry has been around since the Abenomics started in 2013. There has been devaluations of the Japanese yen, and there has been a lot of questions on whether the Asian economies would follow. Now, what we saw from Abenomics is that the lower exchange rate, the lower value of the yen, seemed to have worked, but the power of that policy is not as strong as it used to be because of the global recession. So it's questionable at the moment whether China would actively want to take that approach, especially given the increase in debt burdens that we talked about earlier for a lot of Chinese firms which borrow money from global markets.
Now let's talk about Korea. The Korean won has been largely in sync with the fall or the rise of the Chinese currency. Why so?
Okay, well, part of it is general pessimism around the Asian region. So Chinese economy is not doing well, Japanese economy is not going as well as expected, and U.S. economy is getting better, so some of the funds are flowing out naturally. And then there's the Korean economy is very closely tied with the Chinese market. So if the China's market is not doing well, then they expect Korean export to China will fall. So there's a natural similar trends there. And then another independent factor is that, well, Koreans themselves, we ourselves are not very optimistic about this year. So that naturally brings down investor expectations, so they're moving the funds out. So all those three factors, I think, are trying to push Korean won down, similar to the Chinese yuan.
Then looking ahead, what kind of shocks or changes should Korea brace for, and how should the Korean government prepare and for what's to come, I guess?
Okay, well, there's always a chance of Chinese surprise. We've seen a couple already.
Definitely.
So the government does need to be monitoring closely what's going to happen. As far as whether Korea should follow Chinese devaluation, I'm a bit skeptical on that for the moment, because as I said before, the devaluation method of trying to increase your exports does not seem to be working as well as it did, say, 10 years ago. And also, a lot of Korean firms have borrowed heavily from abroad as well. So if we devalue too much, then the burdens for those firms will go up. So I think careful monitoring is what's needed here, rather than trying to think of what would happen in the case of disaster.
All right. Thank you so much for your insight today, Professor.
Thank you.
And that wraps it up for today, but we'll be back tomorrow with more business news that matters to you, so don't forget to tune in then. Thanks for watching, and see you soon.